Hello, folks. This is Steve Memory from Iconic Wealth Management with an educational economic update for June 2019. In this month's video, I'll discuss some of the major headlines that influenced markets in May. I will also provide insight into what these developments could mean for you as an investor. So please, stay tuned at the end of this video for a required disclosure statement. We've all heard the old joke, if April showers bring Mayflowers, what do Mayflowers bring? Well, this year the punchline isn't little pilgrims. Instead, May brought increased trade tensions, an inverted yield curve, and a decline in the three major stock indexes. So let's review what happened. The U.S. and China have been in trade negotiations and look to be nearing a deal following meetings back on April 30th and May 1st. By May 5th, that optimism was gone as the Trump administration accused China of negotiating in bad faith and backsliding on commitments. At the same time, the president announced an increase in tariffs up to 25% on $200 billion of Chinese goods. On May 13th, China retaliated with their own tariff hikes, setting the background for a difficult month for investors. As May ended, the trade war expanded to a second front with the announcement of a U.S. tariff increase on Mexican imports, this time tied to immigration issues. Compounding the uncertainties associated with trade was the inverting yield curve. Now, this is a term that many of you may have heard, but you may not be entirely sure what it means. So when we mention the yield curve, it helps to know that we're looking at the percent of interest paid by the 10-year U.S. Treasury note compared with the percent of interest paid by the 3-month U.S. Treasury bill. Now, in normal environments, investors expect to receive a higher interest rate for investing in the longer 10-year note, rather than from the shorter 3-month bill. Now that makes sense, right? An inversion happens when the interest received for the longer 10-year note is lower than the interest on the shorter 3-month bill. Now there are two ways this can happen, and the distinction is important. In the first case, the 3-month yield increases above the 10-year yield. This is often a sign of falling economic growth, and if it continues for a significant amount of time, usually signals a recession. In the second case, the 10-year yield drops below the 3-year yield. This is a rarer occurrence and may signal a global adjustment away from risk rather than a looming recession. This second rarer case occurred on May 23rd, when the benchmark 10-year fell below the 3-month bill yield. The 10-year yield remains at its lowest level since September of 2017. So how have markets reacted? Pressured by the trade war and the yield curve uncertainties, the Dow Jones Industrial Average dragged a 6-week losing streak into the start of June, ending with a loss of about 1,777 points, or almost a 6.7% decline, while the S&P 500 gave up more than 193 points, or just shy of 6.6% on the decline. The Nasdaq fared worse during May, opening the month with losses on 7 out of 8 days and promptly extending its losing streak 4 weeks, ending the month with a loss of 642 points, or about 7.9% on the decline. We saw losses across almost all sectors of the economy, with declines of more than 7% in energy, technology, materials, industrials, and consumer discretionary. Investors also moved out of companies with more than 50% exposure to China, particularly in big-cap technology stocks and semiconductors, after several companies suspended business with Chinese telecom giant Huawei Technologies. So what does this mean as we head into June and the summer months? Well, one point we mention often here is that ultimately, fundamentals drive the economy. As investors, we need to focus on those fundamentals and try to tune out the noise, or to put it in summer terms, we need to focus on the movement of the tides, not on the crashing of the waves. So let's look at some of those fundamentals. The second quarter reading on first quarter GDP confirmed that the U.S. economy grew at a healthy pace. Preliminary GDP growth of 3.1% was better than the revised 3% of the consensus forecast. Q1 earnings grew 2%, and this is especially significant since consensus expectations projected a 4 to 5% annual decline. And while stocks slumped in May, the markets continue to have a positive year-to-date returns. All in all, the outlook is favorable for solid domestic economic growth, and valuations have become more attractive as interest rates declined. While we are cautiously optimistic in the short term, we remain bullish on the long-term prospects for the U.S. stock market and the U.S. economy. Now, if June ends without progress on Chinese or Mexican trade deals, a more defensive portfolio tilt may be warranted, but we'll be keeping a close eye on this as the summer progresses. That's it for this month's Educational Economic Update. Once again, this is Steve Memory with Iconic Wealth Management signing off for the month of June 2019. Please remember that nothing we talk about here is a recommendation. If you would like to discuss your personal financial situation, please give us a call at 703-891-9518. We'd be happy to talk to you.